Hello, Amsterdam. My name is Root, the Rational Root on Twitter, and I do cycle and on-chain analysis. And I value privacy, as you can see. You know, I'm a carrot who loves to make awesome Bitcoin charts, like the one that you can see behind me. It's Bitcoin represented as the monetary black hole. And you can see Bitcoin's price spinning inwards, absorbing all value. And the price is shown not in dollars per Bitcoin, but in sats per dollar. How much sats can you get per $1? And the price is spinning inwards, where the center of this black hole is sat dollar parity, where one sat equals $1. And each rotation in this circle, it represents one halving, or 210,000 blocks. Now, why is Bitcoin absorbing all this value? It's because Bitcoin is the hardest money. And why is Bitcoin the hardest money? Because Bitcoin scores really well on all monetary properties. And in today's presentation, I want to zoom in on one of those properties, which is scarcity. And we're going to look at digital scarcity in particular. And we're going to look at it through an on-chain lens. But I really like to get to the root of things. And so we're going to start from the very basics so everyone can follow. And we're going to work our way up to view digital scarcity from an on-chain perspective. Now, we always had physical scarcity. But with Bitcoin, we now have digital scarcity. And it turns out there were always two ways of doing money. You could do money through a ledger system or through an object. And there is a clear difference between the two, because an object doesn't require any information. The information is carried by the object itself. If I have a gold coin and I give you the gold coin, I no longer have it, and so there's no need to keep track of any information. Whereas with a ledger system, we need to keep track of the order of transactions, because if we lose that order, if there's tampered with that order, then we lose scarcity. And a ledger is nothing new to Bitcoin. Ledgers have existed as far back as the island of Yap, where they would use raised stones. They would carve who owns what to who in one of those stones. But in the digital world, we cannot use, obviously, physical objects. So we're bound to using this ledger system. Now, as I said, using a ledger requires maintenance. And so if someone has to think of, for example, the Federal Reserve, who manages the US dollar balance sheet. So usually, the maintenance is done by very privileged people, or maybe by a group of people, maybe that have a high stake in the network. Wink, wink, notch, notch. So what happens if someone tampers with that ledger? Well, we get inflation. And so, for example, if we look at the US dollar money supply, we can see this clear parabolic pattern where almost during the pandemic there in the end, you can see it go near vertical. 25% of all that supply was printed in just in the last 2 years. Now, I don't have to explain the problems of inflation. We're currently experiencing all of them. And so how does Bitcoin solve this? Well, Bitcoin solves this through a decentralized consensus mechanism with the use of proof of work. So with proof of work, we can actually tie the physical world to the digital world. And so the physical energy, or real world energy, is used to maintain the scarcity in the digital world. And so that is the invention of Bitcoin. And for the first time, now it's possible to have a cap. We can have digital scarcity. And Satoshi chose arbitrarily 21 million Bitcoin as the cap, and it doesn't really matter what the cap is as long as there's a cap. Now we can see a different pattern. We have a curve that flattens out. And so we could call the scarcity of Bitcoin 21 million. You know, that's the eventual scarcity. In the next 100 years or so, the remaining 2 million will be mined and entered to the supply. But a better way to look at digital scarcity, or at Bitcoin scarcity, is the current circulating supply, which is around 19 million. And so now, to make the transition into price, because we're going to analyze the market here as well a little bit. To make the transition to price, based on this, actually price models have been made. For example, the stock-to-flow model, where the stock would mean the current circulating supply, the 19 million coins, and the flow would be the inflation rate, which here is shown as the curve as it flattens out, but then on an annual basis. Now, we all know that the stock-to-flow model didn't have perfect price predictions, and there was some valid critique. I'm not going to argue against any of that. But what I want to show here today is how with on-chain analysis, we can actually narrow down this supply even further. So that's what we're going to look at now. Now, to narrow this down, we need to actually classify the supply. And classifying the supply can be done in different ways. We can look at the age of coins. So because we can analyze the ledger, and we can if we analyze the ledger, we can see all the transactions. And so we can look at the age of transactions. So, for example, young coins versus old coins. Or we can look at spending behavior. And in this particular case, I want to look at spending behavior. And so I'm going to give an example because it's easiest to learn by example. So we have two people using the Bitcoin network, a hodler and a trader. Now, the hodler is just stacking Bitcoin. He's putting his salary each month. He's putting his salary all into Bitcoin. Now, he does want to come to this awesome conference in Amsterdam, so he does just spend that last little bit. Now, we have a trader, and the trader is maybe also stacking a little, but then he maybe wants to take some leverage, and he gets liquidated, or maybe he stacks a little more, or maybe he wants to trade some alts, loses out on some money, it stacks a little more. So he's a lot less reliable. Now, we can classify this by if someone spends less than 25%, we can call that supply illiquid. Now, if someone spends more than 25%, we call that supply liquid, because that supply could basically be spent at any moment in time, whereas the hodler, doesn't want to part with his Bitcoin. He wants to pass it on to the next generation. And so if we do this for the whole supply of Bitcoin, we can see that we get this result. The majority of coins is actually illiquid, which makes sense because Bitcoin, the main use case of Bitcoin, is a store of value. And so the liquid part could be actually seen as Bitcoin's scarcity. If you think of price as a reflection of supply and demand, the supply is actually are the coins that are available for trade, and which is the liquid supply, as shown in this graph. Now, is there another interesting observation that we can see from this graph? Now, let's look at the growth rate of a liquid supply versus the growth rate of the total supply. Now, we can see that the growth rate of the total supply is always outpacing the illiquid supply. For example, in the first halving, we can see 3,900 coins a day are added to the network, whereas only 2,700 coins a day are becoming illiquid. And so that remains until the third halving here. And so actually the supply of Bitcoin is becoming more abundant. The liquid supply available for trade is becoming more abundant, which actually naturally would reflect in diminishing returns, which we have seen in Bitcoin's history as well. Now, an interesting thing is that since the third halving, we only have 900 coins a day added to the supply of Bitcoin, according to Bitcoin's inflation schedule. And we have 1,700 coins a day added to illiquid supply. So illiquid supply is currently outpacing the growth rate of the total supply. Now, you could argue, well, haven't we seen that in the second halving as well? In the beginning there, after the second halving, you can see also this huge increase, and then it kind of flattens out. And the answer is yes, that could be. But let's zoom out a little bit. Because with Bitcoin, we know the future supply schedule. So we can zoom out a little bit. And now let's try to model this illiquid supply growth. And this is a model I made, and I call it a HODL model, which is a conservative model of trying to predict the future growth rate of a liquid supply. And it's a very conservative model. As you can see, we are above the model value. But the interesting thing is that even with this conservative model, still at the third halving is the inflection point, where is the highest amount of a liquid supply versus a liquid supply. And so after the third halving, liquid supply is narrowing down, Bitcoin is becoming more scarce, whereas before the third halving, Bitcoin was becoming more abundant. And now let's zoom in on that liquid supply a little further. We're going to look at it in percentage terms. So how much percent of a liquid supply, is shown versus illiquid supply, on any given day? And we can see here that, for example, at the third halving, we had 28% of the supply being liquid, and where the remaining 72% would be considered illiquid. And I also translated the HODL model into this chart, and it's immediately obvious, maybe even more visible in this chart, that the third halving is this inflection point, because you can see that the HODL model tops out. That's the most supply. Bitcoin was the most abundant there. And since then, we have going down, and we've going down steeply. Now, we are actually quite below the model value. We could return a little bit more to that model value towards the fourth halving, but it seems that around that fourth halving, we're going to have a Bitcoin that's going to be a lot more scarce than we had at the third halving, maybe more like the second halving. And if we look, we're going to add the price to this as well, and those white dots that you can see in the price line are the all-time highs that we made. And in the first halving, this green dot that is shown, you can see that we had 21% of the supply being liquid. And we had these huge price increases in 2013. Now, at the second halving, we had around 25% of the supply being liquid. And we did a 20x or so. Now, in the third halving, we had 28% of the supply being liquid, available for trade. And so that was the highest amount that we ever had. And we had we still had a reasonable bull market, but it was a little disappointing. Now, that kind of makes sense, right? We had to start out from an abundant Bitcoin. But since then, we have been going down quite a lot. And you might wonder, why, if Bitcoin is so scarce now, why is price so low? Well, as I said, price depends on supply and demand, and this is only the supply. Now, can we also estimate demand, and can we measure demand in a way? And there's various ways of doing this, but my time is almost up. So here you can see this white line, which is a proxy for demand, also done through on-chain analysis. And you can see that those peaks, they correlate with those all-time highs, with those white dots. And we can see that demand currently is at this all-time low. Right? We only had this peak of demand in April, and then it flattened out. But we can see this clear pattern in the demand signal that it seems to return every halving. So if it's going to return the next halving, Bitcoin is going to be a lot more scarce. Thank you. If you have any questions, you can still find me somewhere in the back. I'll be walking around, but there's no more time. So thank you very much.